Hello friends. Welcome back to Titiksha Finance, where we build real wealth through patience, discipline and deep understanding, not hype. Today I want to talk about something much bigger than short-term market noise. According to one of the clearest macro frameworks released this year, the Global Macro Outlook 2026, we are living in a brave new world. The old playbook of unlimited cheap capital, financial assets, and endless globalization is breaking. What is replacing it? A world of high debt, sticky inflation, reindustrialization, and capital scarcity. A world where real assets, gold, copper, uranium, energy infrastructure, mining and hard commodities, are quietly taking center stage. The new economy gave us innovation. But the old economy is now providing the foundation. And the investors who understand this shift early and have the patience to stay with it will have a serious edge. In this video I'll break down why capital is rotating from soft assets to hard assets, why nuclear, metals and energy infrastructure are becoming structural themes, and how the Titiksha mindset of patient endurance fits perfectly into this new regime. Hit like if you're ready. Let's dive in. Let's look at the real split between old economy versus new economy. For the last 15 years, the new economy, software, internet, AI, EVs, fintech, got almost unlimited cheap capital. Less interest rates meant companies could grow without profits. Valuations went parabolic. But the old economy was left behind: mining, traditional energy, heavy industry, hard assets. Capital was scarce for them because of ESG pressures, regulatory hurdles, and low commodity prices that made returns unattractive. Now the world has changed. Global debt to GDP is at record highs. Governments and corporations have borrowed massively. Central banks are no longer able to keep rates at zero forever. Inflation isn't disappearing, it's becoming structural because of deglobalization, energy transitions, and fiscal deficits. Result: capital scarcity returns. Money is no longer free. Companies and countries now need real, tangible things: copper, uranium, nickel, rare earths, energy infrastructure. You can't build an AI data center or an EV battery plant with software code alone. You need physical inputs. Let's look at the broader old economy themes that matter. First, hard assets and commodities. Gold, silver, and industrial metals act as classic inflation hedges. Why? Because you can't print more copper or lithium. When fiat currencies lose purchasing power, hard assets hold value. Second, raw materials and mining. We are entering a multi-year commodity supercycle. Copper demand for electrification is exploding, but new mines take 10 to 15 years to develop. Supply is constrained. The same goes for nickel, graphite, and rare earths. Third, energy storage and traditional plus transition energy. Lithium batteries and pumped hydro are important, but baseload power is the real bottleneck. Natural gas and coal still provide reliability while renewables scale. Fourth, and most important in my view, nuclear renaissance. This is the ultimate old economy comeback story. Nuclear is clean, reliable, high-density power. Countries like India, USA, France, and even China are accelerating new plants and small modular reactors. Uranium prices have already moved significantly. Companies in the nuclear supply chain, from miners to equipment makers, are positioned for decades of demand. In India specifically, we have ambitious nuclear targets under the India Energy Security Scenario. Companies like NPCIL and listed plays in the ecosystem deserve close watch. Defense and energy security are converging. Pause. The common thread. These sectors require huge upfront capital and long payback periods. In a high interest rate world, only the strongest balance sheets and patient capital will win. That creates scarcity premium. Here's the investment logic. 1. Inflation hedge. Hard assets have intrinsic value tied to physical scarcity. When governments print money to service debt, commodities and energy tend to outperform. 2. Debt hedge. Highly leveraged tech and growth stocks suffer when borrowing costs rise. Asset-heavy companies with pricing power, mining and energy, can pass on costs. 3. Yield dynamics. In a world of negative real yields, tangible assets become attractive. 4. Titiksha edge. These are not 100x moonshots. They reward patience, deep research and multi-year holding periods, exactly the mindset we cultivate on this channel. Risks exist. Policy changes, recessions, or sudden supply discoveries can cause drawdowns. That's why we combine this with technical analysis, support and resistance, 50-day SMA, volume confirmation, and proper position sizing. So what should an investor do at this point of time? Start building knowledge on copper, uranium, and nuclear supply chains. Look at quality Indian companies in metals, mining and energy with strong balance sheets and low promoter pledge. Consider global exposure via ETFs or ADRs if permitted. Allocate gradually, never all at once. Use rupee cost averaging. Track global cues, Fed policy, China stimulus, geopolitical tensions. In India, sectors like defense, nuclear and critical minerals are getting policy tailwinds. This aligns perfectly with key government policies like Make in India and energy security. Now let's look at the sectors that are likely to stay in focus in the years ahead, and what this means for us as Indian investors. First, real assets, gold and silver. Central banks across the world are actively buying gold and silver. Gold has already overtaken US Treasuries as a share of global foreign exchange reserves. This is a structural shift toward hard money. In India, both physical gold and listed plays in the gold and silver space remain relevant as long-term portfolio anchors. In India, investors can participate through high-quality gold ETFs and sovereign gold bonds. These remain simple, transparent instruments with no promoter risk. Second, copper and aluminum. Electrification, reindustrialization, and the power needs of AI data centers are creating a multi-year structural deficit in copper and aluminum. India has listed companies in both metals that stand to benefit from global demand as well as domestic infrastructure and power capacity expansion. In India, Hindalco stands out for its strong balance sheet, global scale, and consistent capital allocation. Nalco is another clean PSU play in aluminum with low debt and steady cash flows. Third, rare earths and critical minerals. These have become a geopolitical battleground. Strategic importance is rising sharply. India is actively pushing for domestic mining and processing of critical minerals under Make in India project. This theme is still early, but policy support is clearly visible. Fourth, electricity and power infrastructure. The world is facing rising power demand from AI, data centers, and manufacturing. India already has ambitious capacity addition plans. Companies in power generation, transmission, and related equipment are well placed to participate in this multi-year cycle. NTPC and Power Grid remain high-integrity names with strong balance sheets, predictable cash flows, and excellent capital discipline. Tata Power also offers meaningful exposure to both conventional and renewable capacity with improving fundamentals. Fifth, industrials. Reindustrialization requires heavy capital spending on real economy assets. In India, capital goods, engineering, and industrial companies with strong balance sheets are likely to see sustained order flows from both domestic and export opportunities. Larsen & Toubro continues to be one of the highest quality industrial compounders in India, strong order book, clean governance, and consistent execution. Sixth, mining and commodity producers. The broader shift from financial assets to real assets supports mining. Quality Indian mining companies with low debt and strong promoter alignment deserve close attention. NMDC and Coal India are two of the cleanest large-cap mining companies in India, with strong free cash flows, low debt, and relatively high integrity. Seventh, defense. As the US reduces its global security umbrella, countries are forced to spend more on self-reliance. India is already in a strong defense spending cycle. This theme continues to have multi-year visibility. HAL and BEL are two of the strongest names: healthy order books, improving return ratios, and solid governance standards. The common thread across all these sectors is clear. They require large capital, long gestation periods, and patient ownership. Exactly the kind of opportunities where the Titiksha mindset of calm long-term thinking becomes a real edge. Friends, the new economy gave us innovation. The old economy gives us foundation. The smartest portfolios will own both, but with proper balance and patience. This is the essence of Titiksha: enduring volatility with calm discipline, and focusing on real value creation over decades. If you found this useful, please like, share, and subscribe. Drop your thoughts in the comments. Are you increasing allocation to hard assets? Which sectors excite you most? Look forward to your comment. Stay patient. Stay disciplined. See you in the next one.